as we head into the first closing bell on the week. There you go.
And that does it for today's trading action. Again, all three of the major averages closing in the green. The Dow up 197, S&P up just around 0.7%, as well as the NASDAQ. In terms of the sector action that we're looking at today, healthcare, real estate, the only sectors moving to the downside, materials, industrials, consumer discretionary among the outperformers, as well as utilities. Well, let's make sense of what we've seen lately. We want to bring in Megan Hornemann, Verdence Capital Advisors Chief Investment Officer, and we have James Liu, Clearnomics founder and CEO. Megan, let me start with you. So we certainly had the massive sell-off on Friday, a slight rebound, if you can call it today, but we're heading in the right direction. What's your big takeaway from what we've seen over the last couple of trading days?
So I think coming into this week, today's action specifically was just kind of coming off of last week's really oversold conditions across a lot of different sectors in the market. When you look at whether it's relative strength index or you look at the number of days that we've been trading under the 200-day moving average for the S&P 500, this just looks like this was a big washout. We're not saying it's all clear. We're not saying that we won't continue to go lower or test the lows, but it's not surprising that you get some big bounces off of price action like we saw last week.
And James, as we are in this sort of holding pattern, as we await some confirmation from the Fed, as well as sort of passing through some of what we might hear in terms of the tone coming from Jay Powell, what are some of the questions that this period raises?
Yeah, it's great point, Rochelle. Basically, it's been a challenging year for the markets. And right now, we think there's more upside than downside risk, in the sense that the big question, as you're asking, is that will core inflation continue to increase, and what will that mean for the terminal rate for the Fed? And what you've had the last week or so is the market adjusting to the possibility of a higher terminal rate. All these expectations have been shifted up by 50 basis points. And as that happens, it's very natural for stock prices and bond prices to adjust during that period. And I think what we saw over the summer from June to August was a period where the market was able to digest these expectations and then move forward. So we're in a new adjustment period today. Hopefully we get through that over the next few weeks, the next couple of months, and then the markets can start to move forward again from there.
Megan, could the Fed do anything, say anything that would shock the markets at this point?
I think right now the one thing that might concern the markets more is going more than 75 basis points. So we know 75 basis points is baked in. If they go 100 basis points at this point after they've been going consistently for 75, while there is a small expectation that they could, and even if they should, I think that would spook the markets right now. They need to continue with their aggressive rhetoric, their 75 basis point rate hikes. Don't suggest to the market that they're going to cut rates anytime soon. I think that's the biggest concern that I have right now in the market, is that in 2023, as early as the first half, the futures market is expecting Fed rate cuts. They've told us they're not going to do that. They say they're going to stay higher and stay that way. But the market, for some reason, is still pricing in the potential for those cuts. I think that's a little too aggressive. I think the Fed needs to stay on their path. The inflation situation is only starting to show some modest improvements. We have a lot more work to do before we can say all is clear there.
James, what do you think? Do you agree?
I generally agree. I mean, basically, the Fed has been justified in raising rates the way it has and in providing the forward guidance they have. So the fact that Jay Powell provided that speech at Jackson Hole a couple of weeks before the CPI report came out, it was basically right on the money, in the sense that they really do need to hike rates and show that they're serious. And I think the problem with markets so far this year is that markets are basically walking the line between wanting the Fed to fight inflation, but not wanting the Fed to cause a recession. And neither of those things is good for the market, but somehow the Fed needs to somehow balance those two effects. And so what we have now is the Fed saying, look, we're going to project out and give guidance very clearly on where the Fed funds rate is going to be. Obviously, that depends very much on the CPI reports and the PPI reports that come out over the next few months. But with the acceleration in core inflation that we saw in last week's CPI report, the Fed very much should be taking exactly the tack they have, raising rates the way they have, and also providing the message that rates will probably stay higher for longer.
So, Megan, as the Fed attempts to really thread this needle, what does this mean for your expectations for earnings?
So I think what we're going to see in this earnings season is a lot of companies throw everything out. We saw that with FedEx, for example, really a dismal report. But the most important thing that they did, which really resulted in the big decline last week, was that they pulled guidance. So I think you're going to have other companies are taking that opportunity to really lowbar, give a lowball estimate for what earnings may look like over the next year. So I don't expect that this volatility is behind us. I think we'll get past the Fed this week. The markets will be choppy. I think they'll continue to be choppy as we get into earnings season. But then keep in mind that November and December tend to be pretty seasonally good months for the market. So we'll have some of these big hurdles behind us. And hopefully by that point, we'll be seeing a little bit better news from the inflation front.
And James, your expectations for earnings ahead?
Yeah, so current expectations are probably a little bit too high. So right now consensus is that we'll hit about $222 per share on the S&P 500 this year. That's a 10% growth rate year over year. That's probably going to come down a bit with some of these slight downward revisions. But keep in mind, downward revisions does not mean that earnings will shrink or that, that we'll have an earnings recession like we did in 2015, 2016. It just means a slight deceleration. And so even if that comes down a bit, you're still probably going to have above average earnings growth for 2022 when all is said and done. And when you look out to 23 and 24, those numbers will probably come down as well. But right now, the market is projecting 7 to 9% earnings growth each of those years. So I think the basic tension here is that, yes, the economy is slowing, but is it really going to be a recession? And even all that recessionary talk from a few months ago, a lot of that has faded away as well. Now, the question is just how much slower will growth get incrementally? So overall, we still think we're in a good earnings situation. Obviously, we'll wait and see what the next earnings season will look like. But overall, it looks positive. And if that's the case, then really valuations still look quite attractive here, even though there are some risks ahead in the market.
James, you don't see a recession?
Yeah, our general view is that we probably both are not in a recession and don't see a recession from here. Basically, yes, we had 2 negative quarters of GDP, so maybe a technical recession. But when you look at the consensus estimates for the current quarter, we're looking at maybe 0.5%, maybe 1%. So nothing to write home about, but what we're seeing today does not fit the general definition of what most people would consider a recession, which is, a general collapse in the economy. That's not what we're seeing in the labor market. And yes, inflation is high. We all understand that. We all understand the effects of that. We know the Fed is tightening, but we still see very strong indicators across many parts of the economy today.
So, Megan, given all this, given the uncertainty that's out there, how should investors be positioned ahead of the Fed decision on Wednesday and then going forward here over the next couple of months?
So the one thing you can't do is try and be a short-term trader right now. You're going to get yourself in trouble, and that's not the way that we would suggest investing in this market. You got to focus on the long term. You've got to look at areas of the market that have priced in the worst-case scenario. So you had asked the question about recession. There's a lot of areas of the market that are pricing like a recession is either imminent or already has happened. Look at small and mid-cap stocks, the way that the pullback we've seen in those areas. We do think that positioning yourself over the next year, we still think there's some room in that growth and technology names for some what we call kind of price discovery, figuring out where that earnings situation looks and what is the appropriate multiple to assign there. So we think there's a lot of volatility there. Focus on being a little bit of a contrarian. Go where those people have really sold off the worst. So like I mentioned, small and mid cap, and don't be afraid to look internationally as well, because that is another area of the global market that is pricing in a worst case scenario and where valuations are historically cheap compared to U.S. equities.
And James, just quickly, obviously a lot of people focusing on the Fed, but you also have a lot of international headwinds and potentially opportunities, as Megan was saying. What are you watching in terms of things that are outside of the Fed's control?
Yeah, so one of the direct effects of the Fed, but that is not directly in their control, is the U.S. dollar. As the U.S. dollar strengthens, it does create a headwind for many international investments, let alone their economies. And so, we've seen a slight downtick in the dollar. Hopefully there's some stabilization there as a lot of this gets priced in, as a lot of international economies get off the ground. And hopefully that can balance itself out. But generally speaking, the dollar is going to be a headwind there. I think the irony is, too, that it does help to solve some of the inflationary concerns that we have here in the U.S. as well. So the dollar is probably the key thing to watch over the next few months in deciding globally where to allocate.
All right, a big thank you to our market panel, Megan Hornemann and James Liu. Thank you for joining us this afternoon.